Singapore collected more taxes in the last financial year, revenue rising 13.1% compared with the previous year to 68.6 billion Singapore dollars. Now, the Inland Revenue Authority of Singapore says that it reflects the country's post-pandemic economic recovery. The bulk of tax revenue collection came from corporate income tax, individual income tax, as well as the goods and services tax, the GST. Now, all tax types saw higher collections except for stamp duty. That fell due to fewer property transactions. Better corporate earnings as well. They yielded the tax collector some $4.9 billion more in corporate income tax, and that is an increase of almost 27% on year. Meanwhile, higher wages meant that people paid $1.3 billion more individual income taxes, and that is a rise of about 9% compared to the year before. One analyst says that the trajectory of rising tax revenue is likely to continue as new revenue streams enter in the next few years.
Traditionally, there has been a lot of multinationals in Singapore who have got tax incentives which are below the 15% tax rate, so they could be taxed at 10% or 5%. But with this so-called global minimum tax, which Singapore is going to adopt with effect from FY25 onwards, it's set to, if we follow the logic of a minimum 15%, a lot of these companies are going to have to pay more.
A revenue from GST that rose by $1.5 billion, or about 11.6% on year. And that is due to higher consumption and a rebound in international arrivals to Singapore. Mr. Loh says that GST is a more stable source of revenue than income tax that is dependent on the economy.
We would never say never of whether or not tax rates will be increased further, especially in light of perhaps I could see the average GST or VAT rate in the region. It's still much higher than the 9% that we are going to have.
IRAS also disbursed about $4.6 billion in grants to more than 120,000 enterprises, and all of that was to support local hiring and wage growth for Singaporeans.